Welcome to the May 9th, 2022 Advance Report from McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with your weekly fast-paced tour of the financial markets designed to help our clients make great decisions in the months ahead. And I'm also president of McGowan Group Asset Management. We serve affluent families from our headquarters at the Crescent right here in Dallas. We have families around the nation, and it's a pleasure to be with you each and every week. I want to take your investing skills to the next level and help you make great long-term decisions during the corrections of 2022. Some patterns have emerged which we're going to cover. Lots of degradation in equity values. I've got some warnings, but I've also got some opportunities as we go through the program. Now, this is the Dow Jones Industrial Average year to date. I want to give you some key dates and a trading pattern that's emerged here. This is the Fed change in posture. You can see the high in the Dow at about 37,000. Fed changes posture, the Ukrainian invasion occurred, and boom, the Dow hit 32,300. Well, the Fed meeting where they actually raised rates, we went close to that level. This is the Monday meltdown before that Fed meeting. That became part of a pattern, but a little relief rally after. Same thing this week with the Fed meeting. By the way, the next Fed meeting is in late July, and we'll cover strategies associated with that. We have deployed some cash into key areas that pay cash flow that are discounted. Now, look at this. We've got 32,522 on the Dow. At the lows this week, essentially hit on Meltdown Monday before the Wednesday Fed meeting announcements that the rates are going up. The Fed said two things that led to a quick rally which completely disappeared the next day. And that was they're only going to pull about $50 billion a month out of the current printed money, if you will, the balance sheet, and they're not going to do 0.75% in July, which had been a discussion there too. When you raise the cash rates, you raise borrowing costs. The good news is your money market rates are going up, and we're getting 2.5% on a 2-year treasury for the conservative clients that can go right into a non-managed account without cost. And that may have a gain by the time before maturity, but we're looking at some bargains like that we'll see on the conservative side. What is this? This, in essence, represents the market capitalization of all stocks that trade in the United States, the largest 5,000 stocks. So it's essentially the U.S. market and the value. It hit nearly $50 trillion, $49 trillion, at the peak on November 8th. Since then, we have had values go all the way down to 41 trillion at the low this week. That is $8 trillion in equity value out of the system. And the leverage associated with the financial markets is being reduced greatly by the declines in value because you have to de-lever if you're a big trading house. That de-levering obviously is painful. It's been the most painful for the NASDAQ 100, the overpriced technology companies, a lot of those that haven't made money yet, like Rivian and Lucid, the electric vehicle makers. If you're not profitable, even if you have revenue growth, those shares are getting pounded, and those valuations look to be headed even lower. But that's the NASDAQ year-to-date, a minus 22. Moving to what's actually happening with the S&P 500, this is important. Look, earnings growth this quarter, right? We got 436 out of 500 companies reporting. Earnings growth, 7.85%. Earnings growth was 8% this quarter. I realize there was a GDP contraction that we reported last week, but that's subtracting inflation. Nominal earnings growth, 8%, sales growth, 14%. What is that not? Well, it's not a recession after 482,000 net new jobs were added to the economy. However, it is a collapse in multiples, and you see that as the markets go through a rather painful process in the Fed tightening, creates good opportunities for strategic cash. 2 financial planning lessons that we built in for our clients. And by the way, at themcgowangroup.com or networthradio.com, what you can do there is fill out the preliminary client questionnaire for your brainstorming session. In our financial plans, we will pay off debts and hopefully get debt-free when the markets rally, then build cash with the extra cash flow. And when we have opportunities like this, we look at great multiples with good forward, quantifiable expected returns. That includes dividends, it includes discounted global high yield, and we're looking now at where the bargains go for July and in between. Well, the energy sector had a 248% increase in earnings. Not a surprise there. Materials, 42%. What did not work? Consumer discretionary, a minus 42%. If you take the utility bill, the gas bill, the gasoline bill, and the light bill, and add all these up with the food cost increases, what you're doing is constraining consumers. This is going to have a big impact, and consumer discretionary got hit the worst. Now, this is overly optimistic. These are all the guys in Bloomberg that estimate what the S&P 500 is going to make each quarter. And you could see back here in 2019, about $40 a quarter net after tax for the S&P 500. That recovery from the 2020 pandemic, then we spiked all the way to 50. Now, this is actually a little flat period in profits quarter by quarter, and then it's supposed to explode. Well, the real number this quarter was a plus 8%. This is what's happened to interest rates. Has a big impact on the bond market. If you have the Vanguard total bond market, you're down 11% for the year, and the Vanguard total bond market, even though it's low cost, only yielded 2% at the beginning of the year. That is not a good equation for most of the portfolios that use indexing or low-cost strategies. We've got to be smarter than that and pick our spots, because we need to know what our forward returns are. The 10-year Treasury has doubled in yield so far this year. That's the orange line right here. The 30-year Treasury is up by 2/3 in yield, and the T-bill exploded actually from a 0.03 to a current 0.78%. What does that tell you? Cost of money going up and the value of treasuries going down. The best fixed income sector historically during rate increases has been discounted fixed income or global high yield with a good manager. I'm Spencer McGowan, your financial weatherman. Thank you for tuning in this week. We'll be back next week with the updates on the major financial news. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.